When one of the most legendary investors ever is being asked what to invest in, he answers.
And that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin.
No need to spend a lot of time analyzing different stocks and watching YouTube videos telling you what's best to invest in today. You just need to buy the S&P 500 index, relax, and wait. Or is it not that simple and maybe it's better to pick stocks of separate companies in your portfolio? Let's take a look at the pros, cons, and opinions of reputable investors about buying the S&P 500 index. The S&P 500 is probably the most famous stock market index in the world. In 2023, the S&P 500 represents around $32 trillion out of a total market value of $40 trillion for all public companies headquartered in the US. So that's 80% of the entire market. Not each and every company having reached a large capitalization can get into this index. To do so, it still needs to show profitability over the last 4 quarters, as well as having enough shares publicly traded. That brings us to the first upside. The S&P 500 is a well-diversified set of stocks, as it includes companies from all sectors of the economy. Today, tech companies make up the largest portion of the index. What it will look like in a few years, no one knows. But the index will still be just as well diversified, and you won't have to worry about keeping all your eggs in one basket. And from here comes another upside. The index's mix is constantly changing over time. Companies have to earn a place on this list and be able to keep it. The weaker links are constantly being eliminated. Take a look at how the top 20 companies have changed over the past 20 years. Shares of today's S&P 500 leader, Apple, were selling for 30 cents in 2003, and its current price is about $170. Microsoft, today's number 2, was number 47 back in 2003, and Tesla has now displaced the once leading General Motors and Ford from the top of the list. Looking at all that, ask yourself this question: are you sure that the companies you invest in today will still be leading the way in the next 2 decades? There is a hunch that the companies that will be leading in 2043 have not yet even been founded yet. All of these risks are taken by the index for you. It constantly includes the best of the best and discards the weak ones all by itself.
The trick is not to pick the right company. It's because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500 and to do it consistently.
The previous 2 upsides provide the third. The S&P 500 has a long-run average return of around 9% per year, which even once you adjust for inflation would have returned you some impressive gains. Let's assume that 40 years ago you invested $1,000 in the S&P 500. Today, that amount would turn into nearly $78,000. Even once you adjust for inflation, the value of your original investment today would be valued at $25,000 in 1983 dollars. There is no guarantee that by investing today you will get the same result 20, 30, or 40 years from now. However, it is better to invest your money in something with a long history than in something questionable. Most professional investors have never been able to beat the S&P 500 in terms of returns.
I would hate to manage $1 trillion in the big stocks and try and beat the indexes. I don't think I could do it.
Over the past 10 years, the majority of the best hedge funds and institutional investors have not beaten the return to the market that you could have got with a simple index fund. These crazy stats show that even with all their knowledge and skills, most mutual funds can't compete with the index.
I recognize the logic of the fact that S&P algorithm is very hard to beat. In a diversified portfolio of big companies, it's all but impossible for most people.
But of course, the S&P 500 has its downsides. If you're not a US citizen, investing in a local stock market will be a little different than investing in a foreign market. First, none of us have a crystal ball, and there is no guarantee that the US market will continue to outperform international markets in the coming years. The US has outperformed international stocks 8 out of the last 10 years. However, there have been times when the returns on international stocks have been higher than US stocks, such as between the dot-com crash and the 2008 financial crisis. Since the entire calculation when investing in the S&P is made in US dollars, a second difficulty comes into play: the volatility of your country's currency in relation to the currency of the states. However, if you invest regularly and over a long period of time, all these volatiles are averaged out. And a final major downside is that the index is now highly concentrated with technology stocks with large capitalization. These giants may not grow as fast as they used to, but judging by history, history, they may well be overtaken by new companies in the coming years. To summarize, index investing is an obvious choice for the ordinary investor. Trying to beat the market is a losing strategy. Instead, it is better to own the entire market. In the long run, investing in the S&P 500 on a regular basis can just relax and ignore market movements. You don't know what will happen in 10 years, but you have to agree that it is much safer to buy a piece of the strongest market on the planet. However, if you want to diversify even more, you can also invest in emerging markets and individual companies. We are grateful to everyone who likes, subscribes to the channel, and watches our other videos.